afternoon, people. Thank you all for coming. So I'm Jon Danielsson, the director of the Systemic Risk Center that was happy to be part of this fantastic project. Otherwise, I would just like to introduce two good friends of mine, Jeff Chwieroth in the Political Science Department here in LSE, and Andrew Walter, who came all the way from Australia. But what they did manage was to write this fantastic book called The Wealth Effect with a very long subtitle, like I'm not going to repeat. But I'm not going to tell you more about the book, but we do have a Twitter, hashtag LSE The Wealth Effect. So if you are on social media, I encourage you to do that. After the presentation, they will mingle and they'll be around, and most importantly, they will take questions, and most importantly, you can get signed copies at the back as you leave. With that, I give the floor to them.
Thank you very much, John. It's a real pleasure to be back here at the LSE, which I left about 7 years ago now for Melbourne. So thank you too to the Systemic Risk Centre for sponsoring this event, the Cambridge University Press for publishing the book and for providing the copies tonight, which I'm afraid are not free, but I believe they might be at least at a discount. And thank you everyone for coming. And it's great to see some familiar faces as well as some less familiar faces. And I just also want to take this opportunity too to thank Jeff for 7 or more years of collaboration on what turned out to be a sort of unexpected journey, but a really interesting and rewarding one. So we wanted to give you a brief overview of the book, its argument, and some of the evidence that we present in the book tonight. It's, I'm afraid, 500 pages, so it's going to be pretty high level and summary, but we're going to give you some snippets of some of the detail. It was a big topic, and when we started off thinking about how banking crises and the politics and policy responses to banking crises changed over 2 centuries, we realized pretty quickly that this was a very ambitious project and that it would take more than a year or two. The main argument of the wealth effect is that policy expectations regarding appropriate government interventions in financial crises have become completely transformed over the long run. And since the 19th century, expectations and mass political expectations of what governments should do when faced with deep, sustained financial instability are now completely different to what they were 100 years, 150 years ago. Just one quick illustration of this, the New York Times, writing in the midst of the 1873 financial crisis centered on New York, and hence particularly pertinent to the New York Times, basically made the argument in an editorial that governments had nothing to do when faced with deep financial crises. No intervention was necessary, banks didn't need to be bailed out, and in particular, in this case, they say, why should government protect depositors? About 110, 15 years later, in another financial crisis, in 1983, this time centered in the Midwest, when Continental Illinois Bank was failing, one of the Big Ten, nationalized by the government, the New York Times transformed its view, or had transformed its view by then, 180 degrees and said, thanks be to government, the bank is nationalized, the financial system is safe. What's the main argument in the book for this transformation of expectations? And I'll give you some more evidence about some sort of deeper underlying mass expectations in a moment. The main argument is that it's the wealth effect, and in particular, mass wealth building up, in particular on the part of the middle class, over time, and especially you can see in this graphic since the 1970s. So this looks at real average wealth per capita in a series of advanced democracies since 1870. On average, by about 1970, average per capita wealth in the household sector in these democracies was about $50,000 US in 2015 dollars. By the early 2000s, it was about $200,000 US. So there's an exponential increase over the past few decades in the real wealth accumulated by households. What does this wealth effect produce? In policy terms, in the aftermath of crises, we argue that very extensive interventions now are expected on the part of the middle class in particular, which has this at-risk wealth. And extensive policy interventions we saw in 2007, 8 and 9 in advanced countries and many others. I don't need to tell a UK audience just how extensive the bailouts and the levels of intervention of various kinds were. But the IMF estimated by the end of 2009 that the UK government had effectively committed 80% of GDP, or the equivalent cost, to financial sector support by that point, 27% for the United States and 15% on average for other crisis-hit advanced democracies. Not only that, so not only was the banking sector supported and in effect bailed out, but the wealth of the middle class was to a substantial extent protected relative to a 19th century style scenario in which governments did very little, just as the New York Times wanted in 1873. So insured and uninsured savings and depositors were protected. Housing and pension wealth was also protected through various micro and macroeconomic policy interventions, and the losses incurred by the household sector in these important elements were far lower than would otherwise have been the case, again, in a kind of 19th century intervention scenario. Not only have the policies been transformed, but the politics too have been transformed by what we call great expectations regarding government interventions in financial crises. So despite governments doing, in effect, as Gordon Brown clearly believed by 2008-9, that he was doing the right thing in protecting large segments of the middle class with their exposed wealth, they were punished. So many voters, so many middle-class households in the UK and elsewhere saw the interventions as fundamentally unfair and redistributive, as bailing out the bankers, a common phrase at the time. Many incumbent governments subsequently lost office after bailing out not only the bankers but also the middle class. And political polarization, of course, in many ways has persisted and in some cases accelerated, and we see dramatic instability. Again, I don't need to remind a UK audience of that. These findings, we think, cast doubt on some pretty prominent theories, at least in political science and political economy, not necessarily on the forefront of your minds, but certainly in the forefront of ours when we were writing this book. Prominent theories such as the argument that democracies are better than autocracies at resisting pressure from financial elites for bailouts. Why? Because taxpayers, in effect, have a powerful sanctioning effect through the electoral process and deter governments from extensive bailouts of cronies. Secondly, arguments that neoliberal ideology since Reagan and Thatcher, as well as the globalization process associated with that project, dramatically constrain the ability and the propensity of states to intervene in crises. And thirdly, that somehow voters might be forgiving of governments that are able to deflect blame by saying that, well, it was a shock that came from abroad. And Gordon Brown, of course, used the argument that the UK's crisis was essentially one imported from the subprime crisis of the United States. Or voters will be forgiving if domestic political institutions get in the way of a rapid and effective policy response. And the United States Congress in late September, early October 2008 was a dramatic example of this. We find very little evidence for these prominent theories, and what we try to offer is a much more dynamic and indeed panoramic, or at least 2 centuries of data and analysis explaining how the relationship between crises, politics, policies, and institutions have evolved over time and produced a situation and a scenario in which governments intervene at their peril, but in effect they are condemned to do so. The main arguments of the wealth effect are firstly that this mass political pressure from the build-up of middle-class wealth lead modern voters to acquire great expectations about what governments should do, and also, in a way, unrealistic expectations that governments can and will intervene efficiently, fairly and at relatively low cost to average taxpayers. Secondly, that governments facing this kind of pressure and democratic electoral threat respond with more extensive and costly interventions that go far beyond the classic so-called Badgett, minimalist Badgett intervention scenario articulated by the former famous editor of The Economist in the 1860s and 1870s in his book Lombard Street, where the most that should be done is for central banks to offer emergency liquidity assistance to solvent banking institutions in return for good collateral and at penalty interest rates. So we're now far beyond Badgett in responding when governments respond to major financial crises. Modern voters nevertheless punish incumbent governments for interventions that they perceive as unfair, as delayed and therefore destructive as well of wealth. And since delays and perceived inequities are almost inevitable with modern messy democratic politics, great expectations inevitably produce great disappointments and electoral punishment, just like in the novel. And this, of course, is layered on top of lots of other challenges. We're not pretending that everything that's gone wrong since 2007 can be laid at the feet of those politicians that intervened under some electoral pressure in 2007-8. But we are arguing that on top of all of the other pressures that modern democracies are facing, from rising inequality to demographic aging and other factors, that these are layered on top of these underlying slower moving structural forces that have made the present political situation particularly acute. So bailouts produce great disappointments and quite powerful political backlash. One of the problems we faced when writing the book was that social and public opinion surveys just don't go back very far, and not far enough in the way that we needed back before 1945 and well into the 19th century. So what did we do to try to measure great expectations? We used a proxy for public opinion, and we used search terms, Boolean search terms, to seek appropriate editorials from digitalized newspaper databases stretching back into the early 19th century in the case of the UK, the United States, and Brazil, three important case studies that we explore in a lot of detail in the book. So we searched for editorials that spoke about either what they believed were appropriate or inappropriate government interventions in principle or actual government interventions, and we trained a series of research assistants to code whether a particular editorial, for example, said that they approved or disapproved of potential government intervention. And what we find, which mirrors the kind of wealth hockey stick that I outlined earlier, is a strong upward trend. So in 1825, the deepest financial crisis in the UK, before 2007, we find the editorials, relatively few, speaking largely and strongly against intervention. So 1 on the vertical scale is low levels of support, strong opposition, in other words, to government intervention, along the lines of the 1873 New York Times editorial. And 4 and 5 are high levels, strong levels of support for government intervention, along the lines of the 1984 New York Times editorial. In the case of the UK, we find in a series of systemic banking crises, and I should also add that we only focus on the big ones, the systemic crises that threaten the collapse of the whole system and therefore threaten the viability of whole economies. And in these crises, the level of support in newspapers from the political left, the likes of The Guardian, through the centre, to the political right, the Telegraph and so on, systematically move over time in the same direction, that is, rising levels of support. Now, newspaper editorials are, of course, a measure of elite opinion, and they might shape public opinion, but modern media studies, journalism studies also suggest strongly that editorials reflect public opinion over long periods of time as well. We did the same study in the case of the United States. I'll just show this very quickly. We did Brazil as well, but essentially both tell the same kind of story. You can see this strong and fairly smooth upward trend, again mirroring the wealth hockey stick in the case of American editorials, so low levels of support from the 1857 crisis right through 1914, and rising levels of support in US newspaper editorials from the left and the right for government intervention from the time of the interwar Great Depression, and very high levels of support much more recently. Finally, before I turn over to Jeff, I want to say a little bit about what we think are the key drivers of great expectations. Just a bit more detail on this. The first driver, what we call the financialization of wealth. And particularly, again, we focus very heavily on the middle class in this book. We're not trying to ignore the role of political and economic elites, but we think that this story about the middle class has been dramatically underplayed in much of the literature and indeed much of the public commentary about crisis responses and the political aftermaths of crises. The first aspect of the financialization of wealth is the size effect. So just the sheer accumulation of real wealth by the middle class, the household sector, since, in particular, the 1970s. And I've already given you an indication of that in the wealth hockey stick graphic. The second aspect is what we call the composition effect. That is, not only are middle-class households accumulating lots of wealth, they are accumulating wealth that is increasingly connected to volatile, traded financial market assets. Leveraged housing wealth, very exposed to financial crisis. House prices can fall, as they did in large parts of the United States, for example, and when that housing wealth is highly leveraged, which I'll come to in a second, that can make this a particularly volatile form of leveraged wealth. Pensions, increasingly connected to traded financial markets too, because there's been a big shift in many democracies towards defined contribution pensions, where, in effect, the value of pensions are increasingly subject to market risk as opposed to defined benefit pensions. I hope all of you out there are on defined benefit pensions. Just an indication for the United States, but probably not, alas. For the financialization of wealth effect, the top graphic measures since 1950, a bit difficult for you to see, right through to 2010, the percentage of household housing equity as a percentage of total household net wealth for two cohorts. One is the middle 50% of the wealth distribution, so approximately what we might think of as one measure of the middle class. By the early 2000s, housing equity constituted about 100% of American middle-class household net wealth. The bottom graphic looks at debt to household net wealth. And again, that grey line, the middle class is increasingly highly leveraged, and about 70% of household net wealth has as its counterpart debt. So this is highly exposed wealth. The bottom black lines in both graphics are the top 10%, so the wealthiest 10% of the US population, and we can see that these people, housing wealth is unimportant for them, and they are not leveraged. So it's the wealth of the middle class which is particularly exposed. The second aspect, the democratization of leverage, a phrase we draw from economists and economic historians will know from important work by Yorter, Schuller, Rick, and Taylor, arguing that increasingly the democratization of leverage, and especially for the purpose of house purchases, has been a crucial long-run phenomenon that has led much of the middle class, not only in advanced democracies on the left-hand side, but also emerging democracies, emerging market democracies, and developing country democracies on the right. Lower levels of average leverage, both in terms of borrowing, but also on the left-hand side in terms of mortgage borrowing in particular. So they start off from a lower base and end up with a lower level of leverage, but the trend is the same. Rising levels of leverage across the board in democracies, whether developing, advanced, or emerging. And the third and final aspect, The first two aspects that I've described are in effect material interest effects, more wealth and more wealth connected to volatile financial markets and more at risk and therefore stressful and anxiety making, because these are precisely the assets that are threatened by large modern financial crises. So these are material interest effects, but there are other signals that are sent by governments when governments commit to financial stabilization, as they did in the case of the United States, for example, with extensive new financial regulation legislation in the 1930s, when they establish financial regulatory agencies and supervisory agencies, often first within central banks and then subsequently on a standalone basis. These send signals to voters. And finally, many countries, including many democracies, nationalized banks and otherwise sought various means of control over the banking sector to stabilize banking since mid-century. And so these government, what we call pre-commitments to financial stability, ratchet up the expectations of voters, and especially the highly exposed middle class, who expect governments to follow through on those commitments when crises strike. This is just a picture of how ubiquitous those financial stabilization pre-commitments became by mid-20th century. The top dark line is the number of democracies in the world. We needn't worry too much at the moment about how we measure that, but the vertical grey bars are the number of democracies that commit through various of these mechanisms to financial stabilization. And by essentially the 1950s, almost every democracy in the world is doing so. Government expectations get ramped up in the process, and particularly during, I should say, the very long period of financial tranquility during the classic Bretton Woods period, in which there were virtually no systemic banking crises. So that ratchets up, we argue, great expectations, because voters understand financial stability as an achievable policy condition. Governments pre-commit and achieve it during the Bretton Woods period. Government expectations, great expectations among the mass middle class persist because of this ratcheting and ramping up effect, despite government efforts to talk them down. Margaret Thatcher tried to talk them down, Ronald Reagan tried to talk them down on welfare policy, social safety net policy, but increasingly regulators and supervisors too articulated so-called zero failure, non-zero failure regimes. If banks and other financial institutions get into trouble, they're on the line. It's their personal responsibility. We will not bail you out, as Mervyn King said in the early phases of the British financial crisis in 2007. The Dutch supervisory agency, undertook a survey in 2010 after articulating these kinds of non-zero failure policy regimes, and found to their horror that voters hadn't bought it. Nearly 2/3 of voters expected that supervisors would never allow a bank to fail in the Netherlands. 3/4 of voters said that, well, if they did fail, we expect you to refund all of our deposits, which is fake news. That is, it's factually incorrect. The Dutch government did not commit to refund deposits over certain thresholds. And 59% of Dutch respondents believe that supervisors should always provide swift reimbursement of deposits, and indeed 80% of these people believed within 3 days. So, almost instantaneous reimbursal, whereas in fact the Dutch standard is 3 months. The UK Financial Services Authority conducted a series of similar surveys from 2003 to 12 and essentially found the same thing. The mass public in the UK didn't buy the attempt to ramp down great expectations. Now I'm going to turn over to Jeff, who's going to talk a bit more about the evidence that we provide in the book for all this, and to wrap up.
Thanks. So Andrew essentially outlined the elements of the book and made a clear sort of two testable empirical propositions, one related to policy responses and the other related to how voters respond to crises and these policy responses. On the policy response measure, what we should expect to see is that given these processes, the financialization of wealth, the democratization of leverage, government policy commitments to financial stabilization, that we should see a shift over time from budget-oriented policies in the earlier period of lower expectations towards bailout-oriented policies in the era of great expectations. And we should be able to tie or link measures of these processes to changes in the configuration of government policies in response to crises. The second empirical proposition is that we should see a change in the way that voters respond to banking crises. They should be less politically salient. In the 19th century, voters should respond or be largely indifferent to market-conforming responses to policy, to government crises, to banking crises in the 19th century. But in the area of great expectations, what we should see is a shift, that voters increasingly punish governments for banking crises despite their interventions due to the wealth losses that they suffer and from perceived inequities from financial rescues. And so what I want to do is to try to tease some of that stuff out for you in the time that I have, but focusing mainly on sort of the general tendencies. In the book, we provide chapters of empirical case studies as well as statistical analysis. I'm going to try to give you snippets of this. The first empirical challenge is how do we measure policy responses to banking crises? What we did was to code thousands of banking crisis responses in over 100 different crises, right? So if those of you familiar with banking crisis responses know there's a range of policy responses that governments can implement, ranging from banking, suffering deposit losses on different actors, closing down financial institutions, providing extended liquidity provision in terms of bailout measures, recapitalizing banks, nationalizing the banks, providing extensive guarantees of the financial system and creditors, defreezing deposits, and creating bad banks or asset management companies, providing debt relief for borrowers, providing deposit insurance or extending the deposit threshold for deposit insurance. So there's a range of different measures that some conform to more budget-oriented policies, more market-conforming, and some conform more to bailouts. So you can imagine a spectrum of sorts, from pure market-oriented responses to pure socialization responses. And then governments sort of adopt a range of different policies, some budget and some bailout. And so we try to code these different responses over hundreds of crises and then put this data together in a nice index. So we use principal component analysis to bring these things together in a nice index to summarize all these different measures over these hundreds of different crises. And what we get is this nice graph that largely conforms with what we would expect. In the area of low expectations, right, in the 19th century, what you see on the top panel is the average policy response, where negative numbers indicate more market-conforming responses towards the negative end of our spectrum, -3, for instance, on this graph. Whereas values towards the top of our spectrum, towards 2 on this index, represent bailout-oriented responses. And the bottom panel is giving you the number of systemic crises that we experience. And what you can see from this graph, hopefully quite clearly, is that in the area of low expectations, we see that bailout responses are largely absent. And in the area of great expectations, they then become largely predominant. And this era of low expectations and bailout-oriented responses persists for an exceptional period of time, as late as the 1930s. But then once the wealth hockey stick kicks in, right, once we get those nice graphs that Andrew showed you earlier towards rising leverage, larging wealth, and so on, governments respond, we argue, through a rising propensity to provide bailouts. In the book, we carry out a series of detailed statistical tests on this. And what I'd like to do is just provide you a snippet of this by showing you some of the simulations that we conducted for various measures. So housing wealth, for most of us in the middle class, is one of our core assets, if not the main asset in our wealth portfolio. And when it is threatened by a systemic crisis, we're likely to feel anxious and to mobilize our opinions towards governments to do something to protect us. So the impact of rising housing wealth should have a severe impact, a significant impact on what governments do. And that's precisely what we find. Consider here, for instance, the increase experienced by the United States from the Great Depression, 1929 to 2007. This is a property price index that we utilize that comes back to the 19th century to the present, with the dashed line showing you when the Great Depression occurred and when the 2007 crisis occurred. And you can see that buildup of housing wealth, right? And so if Andrew and I are correct, what we should see then is that the government index, the bailout response index, should move upwards, right? It should move towards a more bailout-oriented configuration. And that's precisely what we see. When we compare an average country to a country that has experienced the housing wealth increase that the Americans experienced between the Depression and the 2007-8 crisis, you can see that it moves significantly towards the bailout continuum, right? A 33% increase in this regard. We see a similar type of impact occurring from housing leverage, right? So if the democratization of leverage is critical, then our exposure to the financial system in terms of our dependence upon credit, both for housing, but also for consumption or to purchase marketized public services, should also increase the government's willingness to respond to protect us, to maintain the flow of credit. Consider a simulation where we rely upon an example from the Netherlands, from the 1920 systemic crisis to the 2008 crisis. Again, what you see is the dashed lines show you this is different systemic crises, and you can see here the evolution of household debt in the Netherlands over a period of roughly 100 years. If a country were to experience a similar type of increase as the Netherlands did over this time period, you would see a similar type of jump in the bailout index, right? So it's not just housing wealth, it's also leverage that's moving or orienting governments to respond in this particular manner. Andrew mentioned the importance of defined contribution pensions arrangements, and all of you are familiar with this type of arrangement, particularly if you're experiencing some of the changes going on in the USS, for instance, right? One of the things that we see from this type of configuration is that when individuals are exposed to defined contribution schemes, when households are either exposed to these through mandatory schemes like you have in places like Chile or Mexico or Denmark, or even widespread voluntary schemes like you see in the United States, for instance, you can see our bailout index jumps significantly, as shown in the dark bars, compared to the countries where there's no DC arrangements in place, no mandatory schemes, no widespread voluntary use, where it actually shades towards the bailout, the budget-oriented end of our spectrum. So defined contribution pension arrangements we find are having a powerful effect on what governments are willing to do in terms of policy bailouts to us. The fourth thing that we also discussed in the book is this history of effective pre-commitments, right? When governments commit to financial stabilization and they show us that they can achieve that condition, we therefore expect governments to respond when periods of financial distress emerge, because we expect that. We've internalized tranquility as something that's normal, and crisis is abnormal. And so what we do in the book then is a simulation we carry out, and we say, well, what happens when a country has a longer period of tranquility versus a country has a shorter period of tranquility? So you can imagine a country that's pre-committed to financial stability but has lots of financial crises, right? Like in Argentina, for instance, right? So this commitment to financial stability is less credible, but also you don't expect stability. So when it happens, it's not really something that's changing your views about orientations towards governments. But when you have this long period of tranquility, like many of us experienced in this country, or the United States, or most Western democracies, when a crisis suddenly emerges, that's when you begin to respond and mobilize, and governments respond to that longer history, shown here in the dark, with bailouts, as opposed to this shorter history, where they actually respond with budget-oriented policies, as indicated by the gray shading in the negative direction. So what I've tried to do for you is to give you a sense of the statistical evidence for policy responses. And in the book, we play this out also in a series of case studies, the US, the UK, and Brazil, over 200 years of history in each of these different countries. What we also do in the book then is to try to show you that voters respond to these different policy configurations in different ways. What we should expect is that the area of great expectation should induce rising political punishment. Rising political punishment for the reasons I just described for you, in terms of why it is that governments should respond in particular ways to voter concerns about financial stability. So in the book, again, we carry out a number of statistical tests, and we show in the case studies a number of different results that hold in the US, UK, and Brazil. I just want to give you a snippet of that in the time that I have with you this evening. In the area of great expectations, what we should expect is rising political punishment. What this shows you, this graph here on this table here, is the policy response index just for the United States. So not all the countries in our sample, just the US, from the 1873 panic to the 2008 crisis. And what you can see in the US, as we saw earlier, is this gradual evolution towards increasing amounts of government intervention over time, to the point by the time we get to the 2007-8 crisis, the one circled on this graph, we see the strongest propensity, the strongest orientation towards bailouts. So this is consistent with our argument that governments should be responding to voters' expectations for responses. What we also find, however, is despite this bailout, that of course US voters, as many of you are familiar with, punished the Republicans, both for the severe wealth losses that were incurred and the perceived inequities that resulted as a result of this financial rescue. And this graph, we think, encapsulates some of that voter disappointment or voter frustration. This shows you the change in house prices in the period from 2004 to 2008, that's on your horizontal axis, versus the change on the vertical axis in terms of the Republican share of votes changing over time from 2004 to 2008. And what you can see, not surprisingly, is that where you see voters losing a significant amount of wealth in their house due to their house price changes, that they're responding sharply negative in terms of how they're voting. And this is showing you on a county-by-county basis across the United States in terms of how they voted. Right? So despite the bailout, Republicans are losing office in areas where house price declines were most severe. If we contrast that then with an era of low expectations, consider the United States once again. Same graph on your left-hand side. This time we're looking at the 1907 crisis, the 1907 panic, where the American authorities responded in a much more limited fashion and where depositors, particularly in state banks at the time, suffered losses. And you can see a largely market-conforming response. The U.S. provided some liquidity, but not extensive, and there wasn't any of this mixture of policies that we saw in the more recent crisis. And yet, despite this severe downturn, we saw rising unemployment. We saw output losses on the eve of the election close to 11%, so a massive drop in output. Voters failed to punish the Republicans in the next election. In fact, they were returned to office. The graph on your right shows you a state-by-state basis, looking at the number of bank failures on the horizontal axis versus the change in the Republican Party's vote share over time. And the relationship is insignificant, and if you plot the best fit line, it's largely flat. In other words, no matter how many banks failed in a particular state at a given point in time, it's largely unrelated to how it is that voters responded to the crisis in 1907, despite the severely or much more severe market-conforming response the Republicans implemented. A final example for you before I turn to the implications. The case of Brazil. Right, so this is our case of Brazil, and we look at this as a case of not great expectations, but rising expectations. Right? As Brazilians became wealthier over time during this period, their expectations became increasingly similar to those that we see in the more advanced Western democracies. Those of you who are familiar with Brazil, you'll know it experienced an extensive long period of instability in its history, but I want to turn your attention to the graph for the bars circled in 1990. That's the second graph from your right. And you can see that the response is largely market conforming. What the government at the time did, the Collor administration did in a context of hyperinflation or accelerating inflation, was to implement a deposit freeze extensively across the system, where roughly 80% of financial liabilities were frozen at a particular moment in time. What this did in an environment of accelerating inflation was to pose significant losses on depositors, particularly those in the middle class that were unable to get access to their frozen assets. Estimates put wealth losses for the middle class at somewhere in the range of 30% at this particular point in time. So what Collor did essentially was to implement a policy that was inconsistent with the emergence of rising expectations in Brazil. Our newspaper editorial data, which I won't show you now, but we feature in the book, shows you, in fact, this is the period, in fact, when Brazilian newspapers were most supportive of bailing out voters, bailing out financial institutions, protecting deposits. And yet the government moved exactly in the opposite direction as to what these expectations wanted. What should we expect to find from what these editorials called a savings confiscation? We should expect to see declining presidential performance. And that's precisely what we see in this graph. This is the Collor administration's evaluation by voters from inauguration to the point when he resigned following allegations over corruption and pending impeachment. What you can see is that support for Collor evaporates following the savings confiscation, right, which is exactly consistent with what we would suggest. It's also striking, as you will notice from this, is that the following administration, the administration following the following election, the Cardoso administration, provides the most extensive bailout in Brazil's history, and not surprisingly, as we show in the data, it's rather timely and perceived as somewhat equitable in terms of the distributional costs. He's reelected to office, right, which we again suggest is consistent with our argument. We've been talking for quite some time, so now I want to conclude with the implications. One of the key points of the argument, or the book, we think, is to point to a different form of influence on the politics of banking crisis. Right? Much of the literature that you're probably familiar with suggests that policy responses in democracies is largely a form of elite capture. The bankers are responsible, the wealthy interests are responsible. And we suggest as well that it's not just the elites, but it's those of us in this audience, or many of us in the audience, that we should look in the mirror as being responsible as partly a reason for these responses by the governments. Policy captured by whom? By both elites and the wealth-owning middle class. There's just been a growing alignment of interest. One of the corollaries to this, or one of the other implications of this, is that elites also use this growing alignment for their own interest. They use our interest in stabilization to leverage their own interest in financial stabilization. So they can go to the politicians and say, well, if you don't bail us out, then the wealth-owning middle class will also be angry at you. So there's a complementarity here, if you will. We argue, and we suggest recent events in places like Italy, but also elsewhere, suggest that bailouts are inevitable, but that these governments that even they do bail out, such as those in Italy that did so in the end of 2016, face rising political risks from voters. That even if you respond to our interests, that we respond also with a voter punishment, as what we saw for the Italian government that was replaced in the recent election. We also suggest a possible politically induced Minskian doom loop emerges. Right? That essentially when governments guarantee our wealth or provide guarantees for our wealth or put a floor under asset prices, that this gives rise to increasing amounts of moral hazard in the system. We expect to bail out, and so financialization progresses. We take on greater wealth, right? We take on bigger mortgages. We take on bigger credit card debt, and so on and so forth, because we expect governments to stabilize our assets, to stabilize the financial system. This results in increasing amounts of asset price booms, or increasing large asset price booms, and also contributes to rising wealth inequality, and eventually deeper and more destructive crises. The final point that I'll make on this presentation, and this is coupling to what Andrew said earlier, is we also think that what's important, and as we discuss this more fully towards the end of the book, is that a lot of this dissatisfaction, these great frustrations, are layered onto all these other long-term structural changes, right? Things like the rise of automation, China shock, structural evolutionary changes in demographics that have given rise to increasing amounts of frustration, inequality, perceived or otherwise, by voters. And when you layer these types of frustrations, these types of processes on top of that earlier or additional forms of dissatisfaction, what you get are the challenges and some of the fissures in Western society that we are experiencing today. I'm going to conclude with that. I'm going to thank you for your attention, and we look forward to your questions and comments. Thank you very much.
So I think Jon has told us that we will field the questions, and it seems that Jon has got his hand up first. But perhaps I might stand up, because I think I can see a few people straining. So I'll direct questions to Jeff, particularly the difficult ones.
So in that case, the question for you then.
Thanks.
I'm thinking about the implications of what you're saying. I find.
Yeah, wait for the microphone, please.
I find your story very plausible and believable, but I'm just a consumer as I'm an economist, not a political scientist. So I have two questions about implications. So some 20-some years ago, Margaret Thatcher privatized the public housing stock of the United Kingdom with the intention that this would create natural constituency for the Conservatives. Would this imply that she was wrong? The second question is, and I'm just trying to read through your last bullet point, because you basically expressed what I was thinking along. What this is doing is, because this is a systemic risk center, we are essentially heading into a world that has more systemic risk. That's right, yeah. Therefore, is it possible, therefore, because systemic risk will increase because of the forces you are describing, what policy responses would you recommend? Or what policy would you recommend in response?
Okay. Why don't, if it's okay, I'll take the first one, okay, and you take the second.
Go on, yeah.
Just a quick one on Thatcher. I think Thatcher was half right. I think it did, clearly, and I mean, part of the implication of our book is that it's created, financialization has created a very powerful constituency with a massive stake in financial markets today and in liberalized financial markets. But the consequences of that stake have been far from what Margaret Thatcher wanted. as we said, despite the attempts of Thatcherite policymakers and politicians to talk down great expectations and to push the Thatcherite ideology of you take market risks, you buy you take out a 100% mortgage with Northern Rock or a 125% mortgage, you bear the risk, not the taxpayer. Middle-class voters didn't buy that. So they embraced financialization on the upswing and they embraced socialization on the downswing. I also think, in a sense, one might summarize this by saying that voters want bailouts for themselves and budget for everyone else. So there's a lot of, you might say, hypocrisy and time inconsistency in voter expectations, but this is far from consistent with Thatcherite expectations. But she's right, and it clearly aligns with some other evidence that others have provided, that as people accumulate wealth, they tend to shift to the political right. So people with defined contribution pensions, particularly large ones, people with large houses and so on, typically shift to the political right over time. And we see some evidence about people who've won lotteries and so on, quite powerfully demonstrating this kind of effect. Over to Jeff on second.
Yeah, so thanks for your question, John. So in the book, what we talk about early on in the introduction is our pessimism towards the mutual compatibility of three things. One is democracy, the second is financialization, and the third is financial stability. So we talk about how there's a trilemma of sorts across these three different things. In the same way, there's a Mundell-Fleming type trilemma across things like exchange rate stability, monetary policy autonomy, and open capital markets. So we're skeptical that governments can maintain all three, democracy, financialization, and financial stability. Having said that, at the end of the book, we talk about, how can you target these different elements? So neither I nor Andrew are here to criticize the elements present in things like representative democracy. So we're not arguing that you should curtail democracy. In the book, what we do argue is our skepticism towards things like forms of direct democracy. And we argue in the book that, in fact, things like direct democracy, referendums actually give rise to actually greater amounts of instability. We point not only to what's going on in this country in terms of the Brexit referendum and the aftermath of that, but also in terms of what occurred in Italy in 2016, where the government called a referendum on constitutional change. This amplified voter angst and gave rise to some of the fissures in Italian society. On financialization and curtailing that, it's much more difficult. One of the things that voters want is obviously increasing amounts of ability to access the financial system, both for their wealth but also for their consumption. So abilities to damp this down depend upon the government and central banks having the willingness to intervene to prick asset price bubbles, to dampen down leverage. And I see you shaking your head because you're just as skeptical as I am that governments are actually willing to do this, to ramp up things like requirements on loan-to-value ratios to prevent ability for people to borrow. But we think that what needs to occur in a policy framework is to actually ramp up these types of macroprudential regulations to prevent people from gaining access to these things that can make the financial system much more unstable.
I think what I'm going to do is follow a standard LSE tradition and collect questions in groups of three. So we've got a couple. There's a man up back with a blue cap on first.
Thank you. My question regards bail-in, which became incredibly fashionable through TLAC and MREL and contingent convertible debt and whatnot after the financial crisis. And from what I had time to read from your book, you remain skeptical about this as like a silver bullet. But is it a politically infeasible but structurally workable solution, or is it structurally impossible to do because the kinds of investors who will always end up being bailed in will be pension funds and other things that end up hurting the middle classes? Thank you.
Okay, so one on bail-in. I might give that to you, Jeff. Jonathan, and then the gentleman up front.
Yeah, so what you're talking about here is basically a welfare state for asset holders, right? But at the same time as these bailouts have been going on, we've had massive austerity for the other welfare state. And I'm just wondering what the relationship between those two is, whether there's any kind of necessary negative correlation there, whether it's like a political balancing act, you bailed out the banks, now somebody else has to pay, or whether you need to do austerity to shore up financial markets in the aftermath of the bailouts. So do you have any thoughts on that?
Yeah.
Kevin James from the Systemic Risk Center as well. So I had two questions. The first one is that you see the you're in very nice plots where you have this rising tide of intervention in the financial system as a function of housing wealth. But you also see the same sort of plot if you look at the rising tide of government intervention in food safety or in any kind of all kinds of other random issues that don't really have any very strong connection to our housing wealth, at least from the way you set up your theory. Okay? And so basically you have this rising tide of government intervention in all aspects of economic life. So it's not so surprising that you also see it in the financial markets, really. Okay? So that's one question. And the second one is, you contrast the policy responses we have now to the policy responses set in the 19th century. But I'm not sure how you take into account state capacity. So even if somebody had wanted to mobilize 80% of GDP to bail people out in the 1873 financial crisis, there's no way the British state was capable of doing that kind of policy at that time. Right? And so the policy options are actually on. It's not like people had the same option on the table. They were choosing a different set of options in 1873 and a different set of options now. The policy options that were on the table are radically different in those two states. You can't just compare the options people chose. You have to actually think about how they chose relative to what was available.
Okay, thanks. Jeff, do you want to say something about bail-in?
Yeah, I can say something about all three. But maybe we disagree on bail-in.
Go ahead.
On bail-in, the gentleman in the back, thank you for reading the conclusion and promoting the conclusion. We come away skeptical from this. You're exactly right. In the book we talk about recent efforts in the Eurozone to institutionalize bail-in, and then we talk about how the loopholes were soon found in terms of the Italian banking system, various national interest loopholes, and so on. I think, so you asked whether this is structurally possible. I think structurally possible, yes. Politically feasible, I think it depends. I think it depends upon who's bailed in at the particular moment in time and how well other elements of the financial system are protected. So in the Italian case, what was critical is that many of the people that would be bailed in this particular banks were retail bondholders, people like you and me, right? So that was politically infeasible because if you're imposing mass losses on households, it becomes more difficult. But as you mentioned, once these bail-in measures begin to extend to pension funds and pension funds become exposed, that also creates systemic risk. Personally, my own view would be that bail-ins are actually structurally sound, politically infeasible, and I think the more structurally sound idea is to try to figure out a way to dampen down expectations, to gain greater amounts of societal approval for things like macroprudential regulation, right? So that involves the governments and central banks becoming better communicators, explaining to us through common sense reasoning, through different types of frames, maybe related to intergenerational equity or financial stability, that your housing wealth is at risk through this long-term boom, that you're more likely to enjoy a longer-term prosperity with incremental house price increases as opposed to rapid boons. But that depends upon these actors becoming much better communicators. I could say something about the other 2 points about intervention.
Well, I'll just say something quickly about welfare for asset holders versus austerity for the rest. And I think that's a really important point. We don't see the same kind of austerity necessarily being pursued right across crisis-hit countries after 2007. In the particular case of the UK, we certainly wouldn't argue that it was necessary to reassure asset holders. I don't think there's much evidence of that at all. It's pretty clear that the Conservative Party embraced austerity, I think, for fundamentally political reasons. They certainly used the argument that it was necessary to reassure financial markets, otherwise Britain would be threatened with becoming another Greece, and these kinds of arguments that George Osborne and others made. But the consequence of austerity from 2010, and particularly after the Conservatives gained single-party control of government in 2015, was that it layered again on top of everything else that had happened, including large regional wealth losses in the north, outside of the southeast, particularly in housing assets. And it reinforced the perception that much of the largesse of the bailouts, I think, had gone to the southeast and above all the wealthier parts of London. Bailing out the bankers for many Britons, I think, meant also bailing out London above all else, and it reinforced the sense of separation that many people in these so-called left-behind parts of Britain felt. But when our austerity came on top of that and we saw a collapse of public services, again, when many people writing, as you all know, Jonathan, talk about privatized Keynesianism and the idea that increasingly large parts of the middle and working class have to save in order to consume goods that in the past, at least, there was a perception that the state had an obligation to provide as public goods, free healthcare, education, and all of those other important social services that increasingly people feel that they either have to pay for or are only available to a relatively wealthy cohort that are protected even when times are bad. So I think austerity had a dramatic reinforcing effect and we think played a very powerful role in the kind of backlash that we saw in the referendum of mid-2016 in Britain.
I mean, just in response to Kevin's question, which is an excellent one. So in the book, there is a section where we talk about great expectations here and everywhere. So is it a sense that voters just want governments to do more everything across the board? In food safety, you mentioned. And the way we try to deal with this empirically is to look at changes in voter expectations about government intervention more broadly. So we rely on survey data over time to show whether or not there's been a rising trend over time in terms of voter expectations for governments across the board. And we find that it's not the case, that essentially voter expectations are largely static over time. So we think that there's that this particular area may be issue specific, that we may see these expectations only in this area. We also point to other types of evidence that suggests that as voters become richer, as they become wealthier in terms of their housing assets, they become less supportive of government intervention in terms of redistribution. So essentially what we suggest is that, as voters get wealthier, they want governments to do less because they have their own wealth to protect themselves. On the issue of state capacity, another excellent question. So what we do in the book is we try to look at whether or not there was actually both the policy tools available, the policy knowledge, and the policy space. And we do this econometrically, doing various different things. The story I would tell you here is that very quickly that essentially governments did have the capacity to do these things, and they did have the policy knowledge. So we saw interventions on a large scale in certain economies as early as the 19th century, but these were rather rare occurrences. We saw things like guarantees in the French banking system in the 19th century. We saw guarantees in this economy, in the Barings crisis. But what we do see specifically when we look at the detailed data is that in the 19th century, when a fiscal contribution for the government was on the line, it was not a question of internal deliberations about do we have the capacity, it was do we actually have the willingness or the desire to do this in a broader sense. Are people actually threatened? And the answer that the governments largely came by with was no. And so we think it's not a question of space, it's more of a question of responding to voter disappointments or expectations.
More questions? So we've got a few hands up. While you're there, perhaps that gentleman in the front row, yes, right next to you.
Taking Australia as a case, where you've got an oligopoly of banks and heavy exposure to property markets, are there any tools left in the box for an Australian government in a potential meltdown?
Well, yeah, okay, thank you. Yeah. Yes, right next, behind, yes, sorry.
Thank you. You said that your data set focused on big crises. And I guess my simple question is, would your results hold if you looked at whatever you described the smaller set of crises or instability? And I guess where I'm going with that is if your model was that there is always an amount of instability to get through the system, a series of smaller crises would be more popular than the big ones. So, you get to your Minsky point about if you let it all, you're focusing on financial stability, you let it all build up until there's a crisis, then that's by definition a public policy failure. And a smaller series of bankruptcies, the secondary banking crisis in the UK in the 1970s and whatever, are popular because financial stability does not necessarily mean default-free. Question.
And yes, we've had very few women. There's a woman right in the middle there with a hand up. Yep.
Yeah, I wanted to ask about the Minsky doom loop, namely, if you have rising wealth inequality and you see there's also this rise of debt to buy more housing, have you thought about, is there an end of this doom loop? So is there a point where the middle class is so hollowed out that actually your effect is not significant anymore? Thank you.
Yeah, thanks. Perhaps I'll say a little bit about Australia. Yes, Australians congratulated themselves, and particularly the policymakers, and thought that they did brilliantly through the crisis. Of course, as you suggest, having an oligopolistic, pretty protected banking system helped a lot. Having China right next door engaging in one of the largest fiscal expansions in history helped to bail out the Australian economy and, by implication, much of the household sector. Housing prices are starting to look a bit wobbly in Sydney and Melbourne. I'm in Melbourne, and well, I'm relaxed. It went up a lot since we bought in 2013. But a lot of Australians are very concerned. I think I was speaking to the Deputy Governor of the Reserve Bank of Australia a couple of weeks ago. I think his response would be yes, there are tools in the box, there are positive interest rates, and plenty of fiscal capacity compared to perhaps the UK and some other large economies, but the Australian household sector is clearly highly exposed. And it's, I guess related to the last point, how economies like Australia, but not only Australia, get off this conveyor belt when house prices start to wobble, politicians start to start to ease back on proposals to reduce mortgage interest tax deductibility for investment properties and so on, which they, during the boom phase, they start to promote. So there are a lot of concerns now, particularly among the political and policy community in Australia, about how to keep many voters on side, and many policies have encouraged high leverage, and particularly so-called negative gearing in the household property investment sector. So Australian politicians are deeply exposed, just as the middle class is. Again, I think there are sufficient tools in the box, just as there were for many economies back in the 19th century. So we shouldn't exaggerate just how much of the policy arsenal is exhausted. I think we're arguing that it's really this political dilemma that bites hardest for modern politicians, rather than what we might narrowly think of as the sort of market or economic constraints that governments face. I think just quickly on small banking crises, another good question. Before I turn over to Jeff, I think Mervyn King thought that the 2007 crisis as it emerged was a small banking crisis. And when he said, no bailouts, moral hazard needs to be, pushed back against, we'll let Northern Rock go down, and pretty soon Gordon Brown and his Chancellor Alistair Darling started to think about the deep political consequences of the first banking run in British history since, 1890? And, of course, as the crisis escalated into something far, far larger than any of them expected, what began as a perceived small banking crisis changed. So I think, again, because of this deep contradiction between the kinds of sort of neoliberal articulation, no bailouts, moral hazard is a bad thing, people have to accept the consequences of taking financial risk. Many politicians try to use small banking crises or perceived small banking crises to teach people lessons, including the middle class. But the risk is that when they do so, they unleash an unholy financial crisis that no one expected. So small banking crises can escalate into very big ones, and we've seen that over, in pretty recent history. And so that creates, a fundamental political and policy-making dilemma for those people, fighting the fight at the front.
Yeah, on the question of the doom loop, how does it end? Maybe I'm a pessimist here, but I think it ends in disaster, right? That's sort of what we're just talking about here. In the book and some of the subsequent work that we're now working on as well, what we try to do is sort of take these insights and transport them to non-democracies as well. And we find similar types of processes that essentially there's a general demand by the middle class. You mentioned the person who asked the question asked about younger people and younger generations. And what we talk about in elements of the book is that this intergenerational divide actually gives greater amounts of incentives for governments to promote financialization. In this country, you think about things like lifetime ISAs and incentives that the government's put in place to help young people get on the housing market. seemingly in the interest of these young people, but actually who that helps are people like myself and others in the room who are actually already own our property, because that's raising property prices and pushing even further out of reach the people behind them in a generation. So the difficulty here is, how does it end? I think it ends in the types of unfortunately, intergenerational divides that we're seeing in places like this country and in the United States and many Western democracies, that essentially there's a lot of asset-rich older people, middle-aged people who are pitted against the interests of the young, who are unable to acquire these assets. And that's why you're seeing these types of fissures in society and these divisions in terms of how people are voting across different age cohorts.
So I realize there are also some people in the cheaper seats right around the corner I can't even see. So you might, if you've got your hand up, but there's a person down here and a person in the grey sweater at the back. Next. Yeah.
So it seems to me if there's any kind of, I guess, solution to these kind of problems, it would be quite a radical definancialization of the wealth of the middle class. I'm just wondering whether or not you think it's politically possible. Would you kind of advocate those things as a potential solution?
Yeah. Thanks.
Yeah, I'm wondering, you make the case very much for liberal states, welfare states, so the US, the Netherlands, the UK. What's the case for states with a stronger welfare model, Scandinavia, Central Europe? Is there any difference in coalitions and effects?
Yeah, thank you. And you've had a go, John. First, this gentleman here.
Do you have any comment on the role of taxation, corporate or households, in your scheme?
Yeah. Okay, we'll take that round of questions first and we'll come back to some of the other people with their hands up. Perhaps I'll say something about the possibility of definancialization. I think I'll link that to an earlier comment, which is that, as I said, there's a kind of time inconsistency problem. When asset prices are rising during good times, much of the middle class starts to embrace financialization. I think we also distinguish in the book between a kind of risk-embracing middle class that tends to be at the top end of what we might call the upper middle class. People who can invest in second properties and so on. People who may not be in the top 5 or the top 1%, but nevertheless people that are more willing to embrace risk because of the perceived benefits that financialization offers to them. Many people at the lower end who can't, in a sense, benefit from financialization in the same way because essentially they have very few savings to invest. They can't get a second mortgage to buy a buy-for-let property and these sorts of things. So those people tend to be more risk-averse. They also, of course, often see financialization as having been forced upon them. They didn't necessarily ask for it. They didn't ask for a more volatile property market. They didn't ask for defined contribution pension schemes. These were policies perceived as pushed on them. They may be more likely to favor a pushback against financialization, but the middle class is split, deeply split. And it's also split, as Jeff suggested, in terms of generations, and increasingly so. But there is this large segment of the middle class that at least during good times, during bad times, of course, they say, bail me out too. So they realign with the others. But as soon as the bad times are over, and in part, of course, these bad times, the ending of bad times is accelerated by the very interventions that we talk about. Once over, they shift, they break away from that coalition, and they say, well, we can better regulation, Basel III, macroprudential, a few other things, Europe's bail-in rules and regime and so on. This will be enough, and let's get back on the escalator again, the kind of doom loop escalator. So I don't think there's a sustainable political coalition. That political window of opportunity for turning the system around in the depths of the crisis is fleeting. Parties are often split. They're dealing with the short term, and they're often not thinking about the long term in the way that, say, FDR did in the early 1930s. And I think we see very, very few cases where governments are actually able to do what many people asked for, not necessarily what we're asking for, but a radical return to something much more constrained, more like Bretton Woods, financial repression, as economists talk about it. Just a quick thing on Scandinavia, we find actually that financialization as a process is deeply embedded in Scandinavia. Not only places like Iceland, but Sweden and Denmark and so on as well. These are some of the most leveraged households on the planet. And they've got this interesting combination of pretty extensive welfare states, which remember, welfare states are about protecting income and employment, or income that is derived from employment. So the welfare states don't necessarily provide a solution to the wealth risk that we're talking about, but these Scandinavian household sectors are equally exposed, or often even more, and we find pretty consistently that they're also demanding the same kinds of interventions.
Yeah, thanks. 2 quick points. One on definancialization, and then I'll answer the gentleman's question about taxation. So in the book, this has been posed to us several times this evening. We do talk about this in the nation of Andrew's talking about political constituency, and we draw on this wonderful quote from Claudio Borio, who's one of the founders of macroprudential regulation, and he talks about how the problem is that there's no ready-made constituency against the inebriating feeling of getting rich. So essentially, we all want to get rich. Or as one of my students, when I was teaching this version, some of this work in China, said, everybody loves a boom, right? So we all want to get rich. We all want to feel good. Nobody wants to dampen that down. So where do we find these people against that, right? Even young people in the room are trying to get on the housing ladder. You want to get on the housing ladder because you probably want to have housing wealth, housing assets. So it's incredibly difficult. I'm not saying it's impossible. I think we can find ways, and we're actually going to explore this in the future, thinking about how we can find different frames that may convince people to accept the desirability of these types of limits on the ability to get wealthier. But we haven't gotten there yet. On taxation, so this depends on where you sit in the room on the political spectrum on how you view this, whether you think taxation has a better or bigger role to play or less of a role to play. What I will say is in the book we do look at this, in particular how the Labour Party deliberated increasing taxations, increasing rates of marginal tax rate after the financial crisis. There was this big internal discussion about how high can we go in terms of raising the top marginal tax rate. Should we go 45, 50? Where should the threshold be? How much should we tax bonuses for bankers and so on? And what we find, drawing on the work of one of our colleagues in the room, Jonathan Hopkins, is essentially that the Labour Party failed to act because they were worried about sending a negative signal to the aspirations of the middle class. That if I raise income taxes on people at the wealthier end, then they're going to destroy 2 decades of new Labour policies, right? Send a negative signal after, sorry, I should say, a decade of new Labour policies, trying to move them from the left to the center. So that's why they failed to act. There may be an opening, right? So now what we see in social surveys of the British public and elsewhere is there's an increasing, I would say, tolerance or willingness to support greater levels of income taxation on people. So there could be a role there to play. But in the aftermath of the crisis in Britain, what we found is that the UK government, the Labour government, was unwilling to move sufficiently in that direction to make the bailout more redistributive. And if it had done that, it's possible they would have survived the election in 2010, but they failed to do that.
So perhaps this should be the last round. I've certainly got John, but I've also got the gentleman here in the blue sweater.
As you see financialization around the housing increase, I'm curious if you see a similar inevitability around bailouts with regards to climate change and impacts regarding to natural disasters, like flood areas and such.
Yeah. And yes, perhaps, and John, you can have the last word and perhaps wrap up if you wish.
Did you look at the difference in the great expectations between countries where there's a high level of home ownership and where there's a large proportion of rental ownership? So in Germany, for example, there's much, much higher rental.
Yeah.
Do they have the same great expectations?
So Jeff, you've been talking about macro-pro as a possible solution, but is it possible that the same forces you've been talking about here also work against macro-pro tools?
Yeah. Well, we're at the top of the US economic cycle and no sign of much macro-pro. Lots of stress tests and ramping up of minimum regulatory requirements, but yeah, I think that's a pretty telling example. Just say I think Germany's a really interesting case, and we've seen recently in Berlin a lot of pressure for pushback by renters and so on, so the non-asset owning, and I think that may be reflective of a political economy in which renters and non-asset owners are more politically influential. So there are some interesting signs, but AOC hasn't yet taken over the United States and her equivalent in other Western democracies. Climate change is a really interesting one, and we're starting to think about that. Jeff, do you want to say something about that?
We actually have been discussing this for a couple of weeks now with some colleagues in the room. So this is precisely one of the things we're interested in looking at next, which is to think about how the types of processes we're talking about here may affect other types of interests or preferences that individuals may have, right? So you mentioned stranded assets, I think. So one thing we're trying to think about now is how individual preferences with respect to, say, climate change, for instance, may be transformed given their exposure to particular types of stranded assets, right? So we want to think about how it's possible that financialization may actually overwhelm somebody's willingness to support policies in that particular area. But that's an area that we're just now moving into the last few weeks or so. So I think you're right on top of something that's really critical. We think is critical as well. I mean, John, we've gone back and forth on macro-proof for a few years now. I think that, for me, it's an effort that's worth trying. I think it's probably the most credible way to deal with these types of things. And the way that I've been trying to frame it tonight is that it's not ineffective, macro-proof per se, but that we haven't yet found our ability to convince people of its desirability. And that's because I think that individuals often think about, what's good for me as opposed to what's good for other people. And so it's about potentially framing it in a different manner, talking about how, well, if you don't accept limits on financialization, that maybe your offspring will be unable to do it. Or if you fail to accept limits on financialization, your wealth could be threatened by X or something to that effect in the future by a crisis. It's an area that we're moving into, so we think that this is the core issue, right? It's not that macro-proof is not effective, it's that we need to find ways to provide policymakers with the tools to convince a skeptical public that these are desirable. And so we're trying to move in that direction inside, of course, the auspices of the Systemic Risk Center. So we'll be looking at that over the next few years, yeah.
So at least for me, and on behalf of Jeff, I just wanted to thank everyone for coming along. Thanks for your fantastic questions. We can hang around a little bit, and I think we need to move down the back just in case at least we persuaded one or two of you to purchase the book. It's also available on Kindle, of course. But thank you again very much to Jon and the Systemic Risk Center. Thanks to Cambridge University Press, and thanks to everyone here for coming.
Thank you very much.